I'm not a stock picker, but if you listen to enough people, for that matter, watch enough YouTube videos, everyone seems to have some system of their own to beat the market, or maybe they just want us to believe that. However, I came upon something that I found pretty interesting. Using a coffee cup, or rather the shape of a coffee cup, as a clue on when you could make a stock purchase. Think I'm kidding? Well, being the nerd that I am, I did some picking through the research on this subject so that you don't have to. Investor and stockbroker William J. O'Neill first defined the cup and handle chart pattern in his book, How to Make Money in Stocks. I'm going to attempt to explain this. Now, I'm not a finance guru. I don't do day trading or crypto. I'm not sure what a crypto bro is, although I could probably tell you what a bro is. Well, anyway, I'll give this my best shot. Let's say I wanted to buy stock in my favorite company, One Foot in the Grave Productions, stock ticker OFGP, to add to my This Old Broad portfolio. Take a look at the performance of OFGP. Every stock needs a ticker symbol, even a fake stock. At point A, the stock price is rising as ordinary investors want to get in on the action. This pushes the stock price higher. Then it stops at point B. This is where investors that bought at the beginning start to sell to get their profits. At this point, the stock price drops. The price bottoms out at point C when institutional investors stop selling. This is where the bottom of the cup forms. These investors then start buying and the stock price starts to rise. Point D is where those investors that bought the stock at point B sell off to cut their losses. This causes the price to drop to E and the cup handle forms. Trading volume is light because only the weaker investors have sold off. Now you have your cup with a handle. Now, if I draw a dotted line from point B to D, all the way through intersecting the line on the right, I get what is called the ideal buy point, which is point F. The stock should be purchased somewhere between that point and 5% above that point. Volume should be high, indicating that institutional investors, people that supposedly know what they're doing, are buying, thus driving up the price. If you wait too long, you may miss the boat. Alrighty, but does it work? Obviously, this is a little bit more complicated than my simplified explanation here. Even though the price is expected to rise, there's no guarantee, and the price could rise a little and then fall. To me, it seems like something that requires the time as well as the ability of a professional. Professionals have ways to manage risk by knowing when to bail out. This is called a stop loss. Would I use this? Well, it was interesting to learn about. But advice I once got from a financial planner was to never invest in anything that eats or needs fixed, and never invest in anything you don't understand. I think in addition to this would be never invest in anything whose method you don't understand. As for me and stocks, well, I have index funds. Hope you enjoyed this video and make sure you check out some of my other videos.